Hello, and welcome to the Papaya Academy. My name is Amit Levy, and I'm Chief Product Officer at Papaya Global. Today, we're going to explore digital wallets and the unbanked. We'll introduce what digital wallets are and how they're changing habits, especially in emerging markets, and talk about what employers need to consider when paying a diverse global workforce. So let's dive in. Cash is disappearing across the globe. We're seeing a major shift in how people pay for goods and services. The use of banknotes has steadily fallen worldwide from about 26% of in-person transactions in 2019 to just 16% in 2022. It will account for less than 10% of payments by 2026. Digital payments, on the other hand, are surging. A big part of this uptake comes from digital wallets on our phones. In 2019, digital wallets even surpassed credit cards to become the most widely used payments method globally. This trend was accelerated by technology and events like the pandemic, which pushed many people to try contactless and mobile payments. This shift isn't just in wealthy countries, it's happening worldwide, including emerging markets. In Asia, Africa, and Latin America, people pay by scanning QR codes using their mobile phone app, or by transferring money to a mobile phone number. Even smaller vendors and street markets now accept digital wallet payments. The convenience factor is huge. With smartphones, you can store money, pay bills, send money to family, all without handling cash or even visiting a bank. So what does that mean for employers and for payroll teams? It means that traditional pay methods, like only depositing into bank accounts, may not be enough anymore. With such diverse payment habits globally, employers, especially those hiring across borders or managing contingent workers, need to account for different payment methods. Many workers today, particularly in gig economy roles or in countries with low banking access, often prefer to be paid into a digital wallet rather than a bank account. For HR and payroll managers to attract and retain global talent, you might need to pay into a digital wallet, mobile money account, or similar platform instead of, or in addition to, the usual bank deposits. And one of the most powerful impacts of digital wallets is how they enable financial inclusion. There are still about 1.4 billion adults worldwide who remain unbanked, without a bank account. These are often people in developing countries, rural areas, or low-income communities. However, many of these individuals do have brick or flip phones connected to a cellular network but without an internet data connection. And that's where digital wallets come in. Because many wallets don't require an underlying bank account, they become an entry point to the financial system. In Africa, only about 54% of adults have a formal bank account, while mobile phone penetration is around 61%. Mobile wallet services, often called mobile money, leverage this by turning a basic cell phone into a financial tool. A classic case is M-Pesa in Kenya. Launched in the late 2000s, it allowed anyone with a phone to send and receive money. Within a few years, mobile wallets overtook banks in reach. Even back in 2014, 58% of Kenyan adults had a mobile money account, surpassing the 55% who had a bank account. This was revolutionary. Suddenly, a farmer in a village could receive payments or loans on their phone and pay bills digitally, all without a bank. And similar stories have played out in Tanzania, Bangladesh, Ghana, and Pakistan, where digital wallets powered by telecom companies or fintech firms reach tens of millions who were previously cash reliant. Not all digital wallets are the same. It's useful to understand the different types of digital wallets out there. Generally, wallets are categorized into three types: closed loop, semi-closed, and open loop. Closed loop wallets. These are wallets created by a specific company for use only with that company. Think of it like a store account. For example, an Amazon Pay balance that can be spent only on Amazon. This is great for loyalty within one ecosystem, but you can't use that stored money outside of that closed loop. Semi-closed wallets. These allow usage at multiple merchants, but within a limited network. The wallet provider partners with certain vendors, and you can spend your wallet funds at any merchant in that approved network. A good example is Paytm in India or Gcash in the Philippines. Other examples of semi-closed loop wallets are Google Pay or Samsung Pay. Semi-closed wallets have widespread adoption in certain places. Open loop wallets. These are the most flexible. An open loop digital wallet can be used almost anywhere, much like a regular debit or credit card, and often allows additional banking features. With an open wallet, you can usually send money to other people, transfer funds to your bank account, and even withdraw cash from ATMs. Open loop wallets are often provided by banks or in partnership with banks or networks. Examples include PayPal or Apple Pay linked to your cards. Another example of an open loop wallet is Papaya's workforce wallet. With it, employees can receive their wages in their wallet and then use those funds broadly or withdraw them as needed. Open loop systems give the user the most freedom, but they also require the strictest compliance oversight because they behave like a bank account, which brings us to the next point: compliance. Anytime money moves, especially across borders, regulators pay attention, and digital wallets are no exception. Employers that pay into digital wallets need to follow the same AML and KYC rules as they do to bank transfers. In practice, this means when you pay your overseas contractor via a wallet, that wallet service will have procedures in place, like ID verification, transactions limit, and flag for suspicious activity, to ensure the payment is legitimate and compliant with laws. Employers will need to work with trusted payment providers or platforms to ensure the worker wallet is properly KYC verified and that the transfer is tracked and reported according to local laws. And payroll managers need to maintain records and transparency of these payments, just as with bank payments. Digital wallets are revolutionizing how people get paid, and they're bringing millions of unbanked individuals into the financial system for the first time. For employers managing international teams or contingent workers, embracing digital wallets isn't just about keeping up with tech. It's about meeting your workers where they are. It means faster payments, greater inclusion, and often smoother cross-border transactions. Thanks for joining this session. Hopefully, it's given you a solid introduction into digital wallets and the unbanked.